How are investors navigating a volatile year? We'll tell you which ETFs are seeing big money flows in today's Market Moves interview series with an expert who's watching defense and industrials. Plus, we'll do some ETF myth busting. So hit that subscribe button and let's talk to Roger Chandhok, Director of Equity Derivatives on the ETF Desk at National Bank Financial Markets. Well, 2025 has been a year with plenty of volatility. At the same time, as we wrapped up the second quarter, we were seeing all-time highs for stocks in North America with a big rally, in particular off the April lows. For some more perspective on what's been happening in the markets, we're joined by Roger Chandhok, Director of Equity Derivatives at the ETF Desk for National Bank Financial Markets. Roger, it's great to have you with us.
Thank you for having me. I'm glad to be here.
You've got a very exciting job in what's been a very exciting year. How does it work? What do you do? Tell us a little bit more about your job.
Sure. Well, I'm on the ETF Trading and Sales team at National Bank Financial Markets, so it lives under our Capital Markets division. Some will call it a broker-dealer arm. Our ETF offering is comprehensive in the sense that we are supporting the entire ecosystem, right? So we're supporting the ETF issuers in a number of ways, from product idea generation, synthetic structuring for derivative-based ETFs. We're making markets, so we're an ETF market maker for most of the ETFs in Canada. In other words, we're providing liquidity. And then on the ETF investor side, when it comes to institutional investors, wealth management desks, we're providing block trading services, and even retail traders. We are the underlying liquidity provider for a lot of that trading activity.
All right, so we've talked about some investors being interested in safe havens, others willing to take a little bit of risk, and that's sometimes what makes up a portfolio, the diversification from that. Asset allocation in the ETF industry is a growing theme as well, literally being able to invest in that. Can you tell us what you've been seeing there?
Yeah, so this is an area that's one of my favorite topics. It's been an area that's been just on fire. The first wave we saw was in 2017. Second wave was in 2021, when there were a lot of record savings rates because of COVID lockdowns and government stimulus checks. And now we're seeing a third wave, which started at the beginning of last year, where you're seeing huge inflows. Right now, we're seeing anywhere between 1.2 to 1.5 billion in inflows every month into this category. What are these ETFs? They're essentially an ETF that's a basket of building block ETFs that have a target asset mix. They're globally diversified, and they may rebalance if those weightings go out of range. That's sort of how most of them work. So I like to think they're very much akin to your old school balanced mutual funds, in the sense that they're used for a similar reason, sort of a one-ticket solution for investors who want to just invest in one ticket, set it and forget it. We like to throw around the term core and explore, right? So this is an ETF that you can almost use as the core of your portfolio, whether it's 85, 90, 95% of your portfolio, you don't have to think about that. And if you want to take the remainder of your portfolio and do some more exciting things, maybe invest in a little bit more speculative or high octane type products, like maybe crypto or levered ETFs, you can do that. But certainly these products are really good for the core of your portfolio. And the encouraging thing is that we're seeing retail investors really make use of these core asset allocation funds in a real meaningful way now.
All right, well, let's tap into those smarts, including your own, because you're watching all these macro themes and you're watching the flows as well. What has really stood out recently?
Yeah, so it's a big question, just because there, like I said, is a lot going on macroeconomically, from geopolitical risks and events in the Gaza Strip, in Russia, in Iran. There's the trade war that poses a lot of risks for the economy. And one of the things that's done in terms of the characteristics of the market is it's created this sort of dispersion. A lot of differences in how different stocks are behaving, different sectors, different asset classes, different geographies. So investors tend to be very opportunistic now. They're kind of picking their spots where they think there's going to be outperformance. And one example of that is international. You're seeing a lot of investors directing investment dollars to developed international nations outside of Canada and the US. We call this EFI or EA, Europe, Far East, and Asia. These are developed nations that are adding a lot of stimulus to the economy right now. And it's well known that areas where there's a lot of stimulus in the economy, whether it's fiscal expansion or monetary easing, these tend to be areas that are good places to invest, right? So one area is Europe, to be specific. Of the equity inflows that we're seeing this year, over half of the inflows have gone to developed international equity exposure using Canadian-based products.
Big numbers, big numbers. And I think one of the other themes we've seen, especially since you were talking about the geopolitical dynamics right now, and in Europe, this fresh reality of having to fund military-related costs. I mean, you just look at markets like Germany, where the stock market has had big performance this year, as that country, just as an example, has put a lot of commitments fiscally towards things like defense. What do you see when you look specifically at that area like defense?
Yeah, that's a good question. Defense spending is going up. Now, this is something that's been taking place for years, even before the Trump administration started putting pressure because of the conflicts in Europe. Countries like Germany, like Poland, were already increasing their defense spending. And then Trump came along and really accelerated that. And you saw in the NATO summit recently, the NATO allies, the 32 countries, I believe it's 32, they agreed to increase their spending to 5% of GDP. And that's going to play out over the next 10 years. Because of that, you see European defense-related equities perform very well. And the ETFs that are tracking those stocks are also performing very well. So if you look at a few tickers I can think of, there's one, SHLD is a ticker that invests not just in Europe, but globally in defense-related technology stocks. That ETF is up something like 60% this year and has taken in something like 1.5 billion in inflows. So certainly, it's an area that's going to be very interesting, not just now, but like I said, over the next 10 years likely, and the investment dollars are definitely reflecting that. And
I wonder how that trend impacts sectors in Canada over the long term. And I ask that because when we look at a record run for the TSX as an example, part of that is there's been a lot of interest in material stocks because gold's been at all-time highs. Obviously, energy stocks and banks make up a big part of the Canadian stock market, but industrials within the last 3 months of activity have done quite well. And sometimes it feels like those names really sort of play into that global story. What have you been seeing with the industrials?
Yeah, so it's really a question of this new administration and what they're trying to do with the economy. If you look back at the throne speech that took place a few weeks ago, talked about the priorities of this administration, and the priorities are really to re-industrialize Canada, to make it more investable again. They're doing things like tapping into our resource sector, really being part of this energy transition. Another big thing is streamlining regulation. Bill C5, they're talking about streamlining a regulation and also fast-tracking approvals for infrastructure projects. So there's a lot of things going on there, but the general theme is to make Canada a good place to build, to raise capital, to invest. And there are some sectors that we think are going to do very well as a result of this. Industrials is certainly one that's going to benefit because of this fast tracking of projects. And another one is energy. Energy and pipelines is one that we believe is going to benefit greatly from this new revived focus by this administration.
So those are some big sector stories to be watching when it comes to money flows. What about individual investors? I mean, the market has been pretty hot on average, and there's an explosion of ways to invest in the market, especially through ETFs. And we increasingly hear about leverage, the opportunity to use leverage. What are you seeing on the trading desk?
There were some big moves in the market in the first quarter of the year. Approaching Liberation Day, you saw a huge amount of volatility, and the intraday moves were staggering. And since then, when tariffs were paused, or I should say scaled back, you saw a massive rally and markets have recovered dramatically. So there's just a lot going on, a lot of movement. And because of that, we're seeing investors, or retail investors in particular, taking very high conviction short-term moves in using these leveraged ETFs. In the US, leveraged ETFs are now at something like 130 billion in AUM, which is huge. In the first 4 months of the year, they took in about 15 billion in assets. So they're being used heavily in the US. In Canada, we're seeing, maybe not to the same degree, but we are seeing some action in that area. In Canada, we have this newish breed of ETFs, which are lightly levered. So they'll take an index or even single stocks now, and they'll add 25% leverage to sort of magnify your return and even your yield. But we also have your 2 times levered products, and we now finally have 3 times levered products, which are offered by 2 providers. So investors who now want that short-term exposure, that magnified exposure, no longer have to look to the US to trade some of those high-octane products. They now have products listed in Canada to get that magnified exposure.
And out of curiosity, because you mentioned retail investors, do you see any trends where that leverage is playing out in their investments, the kind of areas they're looking at specifically?
You know, there, like I said, is a lot of different exposures that you can get through this. So there is the broad index exposure. You can get exposure to the S&P 500, to the NASDAQ, to semiconductors. And one of the interesting things that are happening right now is single stock. You're getting a lot of this leveraged exposure to single stocks. This is a kind of a new area that's been highly popular in the US and even in Canada now with single stock levered ETFs.
That's helpful context. Now, what are you seeing in terms of the trends when it comes to some of what you might call safe haven investments right now?
So this was a big theme in the first, I'd say, 3 or 4 months of the year, where there was a lot of volatility. You know, the VIX, the volatility index, spiked to over 50, and you saw a lot of investors looking for safe havens, so gold and money markets. Money markets saw a lot of inflows in the first few months of the year. I believe March was a record month for money market ETF inflows. Now, what are money market ETFs? They're essentially ETFs that hold a basket of ultra short-term debt instruments that are issued by governments or corporations. So they have very low risk with respect to duration, with respect to credit and volatility. So a great place to park assets. These instruments have been used for a long time by institutional investors as well as wealth management or investment advisors because they don't like to sit on cash. But it's not something that is really talked about that much for self-directed investors. But I do think it's a great opportunity for self-directed investors who might not be that optimistic about the market right now. They might want to take their assets and let them sit in a money market ETF, clip a pretty healthy interest rate or yield while they wait for a time where they're a little bit more optimistic.
Meanwhile, Roger, can we set the record straight on this subject of volatility and what it means for the ETF industry? You know, for people who wonder if volatility makes things more complicated for the ETF industry. You're watching the flows, you're watching the action. What does volatility mean to ETFs?
Yeah, so this kind of is kind of a myth-busting topic. You know, we get a lot of critics, especially when things are very volatile and the markets are very stressed. And you have critics saying, well, you know, the ETF ecosystem is going to break down. Market makers are going to run for the hills. Liquidity is going to dry up, and the investors are going to be left holding the bag. And it's just not the case. I mean, we see the exact opposite. During times of extreme stress, ETF volume, skyrockets. Now, if you look at this April as an example, when Liberation Day kicked in, those kind of 2 weeks were the largest volume days in history for Canadian ETFs. What's even more interesting is that it wasn't just ETF volume that went up, but it was ETF volume as a percent of equity volume or overall market volume, which tells us that ETFs are sort of a go-to vehicle for a lot of investors to express views or reposition themselves or maybe buy the dip. And at that time, and even other stressful periods, market makers we're always there, providing bids and offers as they normally do and as they're expected to do.
All right, great context. Before I let you go, we like to ask our guests, when it comes to the world of ETFs, if they have any trading tips. What can you share with us today?
Sure. I would say one of the more important tips is use limit orders. Do not use market orders. Using a limit order, I like to think of it as sort of a safeguard, right? So if there's any glitches or any issues, if you put in a market order, there's a chance that you may get a fill that is not that you're not happy with, right? So important thing to do is you look at the bids and offers, and if you see a price that you like, you put your limit order at that price. If you want to sort of increase the certainty that you get filled and you have a very large order, well, maybe you want to put your limit order a penny or two above that. But that limit is the maximum amount that you're going to pay for that trade. So use limit orders, do not use market orders.
Helpful tip. Roger, great to have you with us. Thanks so much for your time. We appreciate it.
Thank you.
All right, our thanks to Roger, and thanks for watching. Got an ETF question? Let us know in the comments. And don't forget to subscribe so you don't miss our next video in our Market Moves interview series. See you next time.